In 2026, buying a house in most major cities is a lifestyle upgrade. But let's be brutally honest about the bank account. It is a massive cash flow downgrade. We need to talk about a concept called House Trap 2.0. This is the uncomfortable reality that mortgage rates at 6 or 7%, combined with sticky home prices, have fundamentally broken the old rule of thumb that said renting is throwing money away. In fact, if you run the math honestly today, buying a home often involves throwing away significantly more money than renting does. I know that sounds like financial heresy. We are conditioned to believe that a mortgage payment pays you back, while rent pays your landlord. But that logic is based on 2010 math, not 2026 math. Today, I am going to show you the unrecoverable cost equation. We are going to look at the money you spend on housing that you never see again, regardless of whether you sign a deed or a lease. And for many of you, this calculation is going to save you hundreds of thousands of dollars. Before we get into the spreadsheets and the ugly details, we need to set the scene for why this decision has become so much harder. If you feel like the goalposts have moved, it is because they have. Just a few years ago, the gap between a monthly mortgage payment and a monthly rent check was negligible. In some places, buying was actually cheaper on a monthly basis. That is not the world we live in anymore. According to recent data from Bankrate, covering the 50 largest metro areas in the US, renting is now cheaper than buying in every single one of them. On average, a typical mortgage payment, including your taxes and insurance, is clocking in around $2,700. The average rent for a comparable spot? About $2,000 flat. That is a 38% premium just to own the keys. In tech hubs or coastal cities, that gap can be over 100%. You might be paying double to own the same square footage you could rent. This isn't just a minor fluctuation. It is a structural shift in the housing market that requires a totally different strategy. This leads us to the first part of the trap, which is what I call the overhousing phenomenon. When we look at rental data, rent-to-income ratios have stayed somewhat steady over the decades, usually hovering around 25% of a household's income. It's tight, but it's manageable. But because of the spike in interest rates and property values, mortgage-to-income ratios have blown past 35% in many markets. What does that mean in plain English? It means that when you move from renting to buying in 2026, you are not just changing your address. You are radically changing your free cash flow. You are voluntarily signing up for a situation where a much larger slice of your paycheck vanishes before you can touch it. And the common rebuttal I hear is, "Well, Tom, that extra money is forced savings. I'm building equity." And that is where I have to stop you. Because in the first 10 years of a high-interest mortgage, you aren't building nearly as much equity as you think. You are mostly just servicing debt. We are going to break down exactly how much of that payment is actually savings versus how much is just setting money on fire. But first, I need to ask you a favor. If you are trying to navigate this weird financial landscape where the old rules don't apply, do me a favor and subscribe to the channel. My goal here isn't to tell you what to do, but to give you the frameworks to figure it out for yourself without getting sold a product. I don't have a course, I don't have a masterclass, I just have these numbers and a microphone. If that is valuable to you, hitting that button helps me keep the lights on and the data flowing. All right, let's get back to the math. Specifically, the one number that changes everything, the unrecoverable cost. The biggest lie in personal finance is the phrase, "rent is throwing money away." It is a catchy slogan, usually repeated by real estate agents or older relatives who bought their houses for the price of a used Toyota Corolla in 1982. The implication is that renters burn their money while owners keep theirs. But the correct way to view this decision in 2026 is through the lens of unrecoverable costs. An unrecoverable cost is exactly what it sounds like: money that leaves your bank account and never comes back. It provides you shelter for 30 days and then it is gone forever. It adds zero to your net worth. For renters, this is very simple to calculate. Your rent is unrecoverable. Your renter's insurance is unrecoverable. That's it. You pay $2,000, you get a roof, and at the end of the month, that $2,000 is gone. There is no equity, no investment. It is a pure consumption expense. Because this is so transparent, renters feel the pain of this loss every month. But homeowners have unrecoverable costs too. They are just hidden behind the complex structure of a mortgage payment and the irregular nature of maintenance. And right now, for many of you, the homeowner's unrecoverable costs are actually higher than the renter's total bill. Let's look at the owner's side of the ledger. If you buy a home today, you have a stack of bills that are mathematically identical to rent. First, you have property taxes. That is money you pay to the government to live in your own house. You never see it again. Then you have homeowner's insurance, which is significantly more expensive than renter's insurance. Gone. Then you have HOA fees in many communities. Gone. Then you have maintenance and repairs, which we will discuss in detail later, but spoiler alert, roofs and water heaters are expensive. Gone. And finally, the big one, mortgage interest. This is the fee you pay the bank for the privilege of using their money. It does not lower your principal. It does not build equity. It is profit for the bank, not for you. When you add all of these up, taxes, insurance, HOA, maintenance, and interest, you get a number. That number is the owner's equivalent rent. If that number is higher than what you would pay to rent a similar house down the street, then from a pure wealth accumulation standpoint, buying is the inferior financial choice. It doesn't matter if the house goes up in value slightly. If your monthly burn rate is double that of a renter, you are digging a hole faster than appreciation can fill it. Now you might be thinking, okay Tom, but eventually I pay the house off, so the interest goes away. And that is true. But most people do not stay in a house for 30 years. The average tenure is much shorter. And here is the part that traps people: the amortization schedule. In the first few years of a 6 or 7% mortgage, the split between interest and principal is horrifying. On a typical payment, it is not 50-50. It is often closer to 80% interest, 20% principal. That means for every dollar you send to the bank, 80 cents is unrecoverable. It is effectively rent paid to the lender. If you buy a house thinking you are saving money, but you sell it in 7 years, you have mostly just paid rent to a bank instead of a landlord, while assuming all the risk of the boiler breaking. And speaking of breaking, let's talk about the silent killer of homeownership returns: maintenance. There is a rule of thumb floating around that says you should budget 1% of your home's value per year for maintenance. So, on a $500,000 house, that is $5,000 a year. In 2026, that number is laughably low. That might cover mowing the lawn and fixing a leaky faucet, but it does not account for the big-ticket items that have skyrocketed in price due to inflation in materials and labour. A new roof? $20,000. HVAC system? $12,000. New windows? Don't even ask. When you look at comprehensive data, like the analysis done by Money with Katie or recent reports from insurance adjusters, the real cost of keeping a home standing is closer to 3% per year over the long run. 3% of $500,000 is $15,000 a year. That is over $1,200 a month, just in upkeep. That is $1,200 a month leaving your pocket that provides zero return on investment. It just keeps the asset from depreciating. If you are not factoring that into your rent versus buy spreadsheet, your math is broken before you even start. But the most insidious unrecoverable cost isn't taxes, interest, or repairs. It's opportunity cost. This is the money you lose by tying up your capital in a house instead of investing it. Let's say you put $100,000 down on a house. That money is now trapped in the drywall. It is not earning 7 or 8% in the stock market. It is sitting there, dormant. If the housing market stays flat, that $100,000 is effectively losing purchasing power to inflation every year. Furthermore, every month that you pay an extra $700 for your mortgage compared to rent, that is another $700 you aren't investing. Over 10, 15, or 20 years, the compound growth on that uninvested cash is massive. We are talking hundreds of thousands of dollars of lost potential wealth. Rational Reminder and other financial educators harp on this because it is the invisible line item that makes housing a mediocre investment compared to a diversified portfolio. When you buy, you are making a concentrated bet on a single asset class with high carrying costs, and you are funding it by draining your liquidity. You have to subtract the returns you could have had from the returns you actually get from the house. Let's make this concrete. I want to walk you through a specific example based on current 2026 averages. We are going to compare buying a $500,000 home versus renting a similar place. Let's assume you have a 20% down payment ready to go. On the buying side, you put down $100,000. You take out a $400,000 loan at roughly 6.5% interest. Your principal and interest payment is about $2,500. Then add property taxes. Let's call it 1.5%, or $600 a month. Insurance is another $200. Maintenance at a conservative 2% is another $800 a month. Total monthly cash outflow? Around $4,100. Now, let's separate the recoverable equity from the unrecoverable waste. Out of that $4,100, in the first year, only about $350 goes toward your principal equity. The rest, roughly $3,750, is unrecoverable. It goes to interest, taxes, insurance, and maintenance. You are paying over $3,700 a month in owner's rent just to hold the asset. Now look at the renter living in the exact same house next door. In today's market, a $500,000 home might rent for roughly $2,500 to $3,000 a month. Let's be generous and say it rents for $3,000. The renter pays $3,000. They pay maybe $30 for renter's insurance. Their total unrecoverable cost is $3,030. Do you see what just happened? The homeowner is burning $3,750 a month in unrecoverable costs. The renter is burning $3,030. The owner is actually throwing away $700 more per month than the renter. And that is before we even talk about the down payment. The renter still has that $100,000 down payment sitting in their brokerage account. If that earns a conservative 7%, that's another $7,000 a year, or nearly $600 a month of investment income working in the renter's favor. So the gap widens even further. This is the moment where people usually get angry at me in the comments. They say, "But Tom, real estate goes up. My parents bought for $50,000 and sold for $500,000. And yes, real estate usually appreciates. But does it appreciate enough to overcome the massive drag of interest, taxes, insurance, and maintenance? Often, the answer is no. Robert Shiller, the Nobel Prize-winning economist, has shown that over the very long term, we're talking 100 years, home prices basically just track inflation. They don't generate massive real returns like the stock market does. The wealth creation from housing usually comes from forced savings and leverage, not from the asset itself performing miracles. But here is the twist. Just because the math favours renting right now doesn't mean renters are going to win. In fact, most renters will still lose. And they will lose because of human psychology, not mathematics. The mathematical advantage of renting in 2026 relies on one incredibly dangerous assumption: that you will actually invest the difference. Remember our example? The owner was paying $4,100 a month. The renter was paying $3,000. That leaves a gap of $1,100 every single month. For the renter to come out ahead in the long run, they must take that $1,100 and religiously invest it in the stock market. They can't spend it on DoorDash, they can't spend it on a nicer car, they can't spend it on vacations. They have to treat that savings with the same discipline as a mortgage payment. But statistically, people don't do that. Most people see the extra money in their checking account and absorb it into their lifestyle. This is why forced savings is the superpower of home ownership. The mortgage bill comes every month, and you are terrified of foreclosure, so you pay it. You are forced to build wealth, even if it is inefficient wealth. Renters have to volunteer to be wealthy, and volunteering is much harder than being forced. So, the phrase I want you to write down is this: rent isn't a trap if you use the gap. If you are renting in 2026 because the prices are insane, you are making a smart, tactical decision. But you have to execute the second half of the strategy. You need to automate the investment of your savings. If you are saving $700 a month by renting, set up an automatic transfer for $700 to an index fund the day after payday. Make it disappear before you can spend it. If you do that, the data shows you will likely end up with a higher net worth over a 10 or 15-year period than the person who stretched to buy that overpriced house at a 7% rate. You will have a liquid portfolio of stocks that grows faster than real estate, without the anchor of property taxes and maintenance. You are effectively acting as your own landlord and paying yourself the equity. Now, does this mean you should never buy a house? Absolutely not. I own a home. Morgan Housel, one of the smartest financial writers alive, owns a home. But we have to be clear about why we are buying. It usually isn't for the ROI. Buying makes sense when you are playing a very long game. The transaction costs of real estate are brutal. Closing costs, agent fees, transfer taxes. They eat up about 6 to 10% of the value every time you move. To spread those costs out enough to make sense, you typically need to stay in the home for at least 7 to 10 years. If you think you might move for a job in 3 years, buying is almost certainly a financial disaster. Buying also makes sense as a hedge against rent inflation. If you are in a city where rents are skyrocketing 5 or 10% a year, locking in a fixed monthly payment for 30 years offers incredible stability. It's insurance against the housing market getting even crazier. Even if the math is slightly worse today, that stability has value. There is also the non-financial dividend. You cannot put a price on the ability to paint the walls whatever colour you want, or to renovate the kitchen without asking permission, or to know that a landlord can't decide to sell the building and kick you out in 30 days. This is why I say housing is a consumption decision first and an investment decision second. If you are buying because you want a backyard for your dog and a school district for your kids, and you can afford the unrecoverable costs, then go for it. Just don't delude yourself into thinking it is the best possible use of your capital. It is an expense that aligns with your values. That is a perfectly good reason to spend money. The danger comes when you justify a lifestyle desire with bad math. Don't say, "I'm buying this massive house to build wealth." Say, "I'm buying this massive house because I want to live in a massive house, and I accept that it will cost me more than renting." So, how do you actually make the call right now? I use a simple decision grid. If you are in a high-cost city like San Francisco or New York, where the price-to-rent ratio is massive, renting and investing the difference is almost always the winning mathematical play. The gap is just too big to close. If you are in a lower-cost area, where you can buy a house for maybe 15 or 20 times the annual rent, buying becomes much more attractive, even at higher rates. But regardless of where you live, you have to run the unrecoverable audit. I want you to pull up Zillow and find a house you like. Look at the estimated mortgage. Then look at the estimated rent for that same house. Calculate the unrecoverable costs for both. If the owner's unrecoverable costs, interest, tax, insurance, maintenance, are higher than the rent, acknowledge that you are paying a premium for ownership. Is that premium worth it to you? Only you can answer that. Let's wrap this up with the core takeaway for 2026. The house trap happens when you buy a home because of social pressure or outdated advice, only to find yourself house poor and building equity at a glacial pace. In the current economic environment, with rates higher for longer and prices refusing to crash, the math has tilted towards renting in many markets. But remember, renting is only a win if you are disciplined. The renter who spends the difference loses. The renter who invests the difference wins. The homeowner who stretches too thin loses. The homeowner who buys well below their means and stays put for 20 years wins. There is no universal right answer, but there is a universal right method. Counting the unrecoverable costs. Stop comparing your mortgage to your friend's rent. Compare your interest, taxes, and maintenance to their rent. That is the only comparison that matters. I want to hear from you in the comments. I want to see some real-world data points. If you bought recently, what are your unrecoverable costs looking like? Are you shocked by the maintenance? And if you are renting, are you actually investing the difference? Or is it slipping through the cracks? Let's get a peer review going in the comments section so we can see what this looks like across different markets. If you found this breakdown helpful, share it with someone who is stressing out about buying a home right now. It might just talk them off the ledge. Thanks for watching, and I'll see you in the next one.